I can see how this would quickly become very frustrating. So I heard Daniel going about this question um, about basically going on tilt because of overconfidence. If you've been around me for a while, one of the things that I talked about is in regards to when you go into a series of winning trades, you get this Midas touch syndrome. You think everything you touch, every trade you're going to take is going to be a winner. You're just so dialed in. You're you have this uncanny ability to know exactly what price is going to do next. And the last several trades for the entire week, you've been just killing it, slaying it. And even when scaled in terms of your contract sizes, everything's still delivering, and it's just like a sense of invincibility. I had a bout of that when I first started learning how to trade better, not just simply read a book and think I know what I was doing. And I had that little short period of time where I thought I had everything corrected. Everything's perfect now, and I'm not afraid. I'm not afraid. I'm going to start doing more trades. And the first trade that I had was a losing trade after a series of wins, and I started upscaling the leverage in the bond market. I felt debilitated. Like it was completely scary. Like, oh no. It wasn't the fact that I lost the money, because it wasn't even that much money. It was the fact that I had all this wind in my sails, all this confidence, and it hit me right when I thought that I had everything figured out. And you get this sense that you're invincible. You get this King Kong feeling. And the only thing I learned to do to compensate for that, because you're going to have to continuously take trades, even when you take losing trades, either you have to arrive at the point where you don't do this anymore because you can't take risk and you can't take losses and you can't work through that, or you're going to have to condition yourself to say, I'm not going to be perfect. I'm not going to make money on every single trade, and I can't have winning streaks that go on forever. So what'll happen is you'll have to build in these plateaus. Okay. So everybody imagines the idea of you going in, starting with one contract, building out to two contracts, then the four, then the eight, and then 16, 32, 64, and vice versa, on and on and on. In a perfect world, that'd be great. But you're going to have plateaus, and your operation as the trader is going to be impacted by reality. Some things are going to happen where you do it wrong. You got in too soon, you got in too late, you picked the wrong PD array, the market just shifts against you, and nothing you're using with that bias is going to work that day. And that's the reality. Sometimes things change and you have no control over it. So what are we left to do? What I learned was, especially if you are someone that's going to be a high frequency trader, that doesn't mean, 30 trades in a day, but if you're trying to trade every day, try this for yourself. If you can go 5 winning trades in a row, okay, and you're trading with more than one contract, say you're doing 2 or 3 contracts on the micro, your 6th trade, even though you may be affording to go up one more micro, or you feel the itch to do that, go down to 1. And what that has shown me over time, and the students I've taught do that, is while you're making money and you're building new equity in your account, the eventual loss is coming, but it's always going to show up when you just raised up your leverage. And by having 5 winning trades and then go down to the smallest scale of a trade you can take, it doesn't seem like that's logical. And I'm sure there's going to be a lot of people, are going to take opposition to that. They're like, no, you have to push your edge when you have it. You don't know what you're talking about, blah, blah, blah. Okay. I'm trading with a real account this year, and I'm pushing the whole micro process. And I put over $400 on that account today. Now, $400 is not a lot of money, but $400 when it starts with a $10,000 account, and I'm trying to produce this mindset in all of you as working class hero approach, not biggest prop firm payout, not Robin's Cups winner. I'm talking about making your ends meet, how to start with humble beginnings. Wait a minute, you said $10,000. I'm already out of this equation. It can be 5,000. It could be 1,000. Whatever it is that you're going to start with. I'm not saying that you should start with anything that I'm starting with. I'm just saying from a hypothetical stance. People ask me all the time, how would I do small account? How would I go into this with a real sober approach to doing it? You can't get any more sober than one micro contract. And honestly, the majority of you listening to me, I guarantee you, whatever you earn at your job, one micro contract in trading you can do that. Like you literally can do that. And I framed the idea around scaling back to one contract after 5 winning trades, and without fail, either the 6th or 7th trade many times would have been where I took another loss. Now, if I was staying with my program that every time I made $2,500, I could do another contract of the bonds. And if I'm building up, building up, building up, on that 6th trade, I may have been in 3 contracts or 5 or whatever it was I was going to move up to, because I wanted to keep building equity. I wanted to keep making more money. Well, if now I scaled back down to one contract, it's the smallest I can trade. And if I took that loss, it felt like a victory. So instead of feeling defeated and deflated and feeling demoralized because I had my biggest position on now, eventually it's going to happen. It may be your 4th trade and you have sides on. Maybe you scaled up because it's your 4th trade. It's still going to happen. You're eventually going to have a loss with your maximum leverage on. You can't avoid it. It's going to happen. If you're going to scale up, that's going to always happen. But my only solution I ever came up with for my own trading, and I've been teaching this to people for 25 years, if you take whatever number it is, it might be 3 for you. It may be 8 trades. It may be 10 trades, whatever it is. Learn to build in plateaus. And what that'll help do is you won't get these roller coaster equity swings where you might be able to be, when you're on the right side of the marketplace and you're hot, you're just doing really, really well, you can parlay a money account up pretty good. But what happens to all traders is they go through that big drop down in equity because they go into a tailspin and they want to get quickly back to that old equity high because they feel like they're failing. It'll never happen. It'll never happen unless they get it back there real quick. So if you can control the degree and severity of the drawdown, and the only way you can do that is by scaling back after you have a series of winning trades, because you know what's going to happen. The inevitable is going to happen. You're going to have a losing trade. So if you build in these, I make money, I add, make money, and stop adding. Go back to one contract. Trade that, okay? And if you don't get stopped out or take a loss, go up one more contract. If you don't get stopped out, go back one more contract and do that. It feels like it's slowing you down. You're never going to get to your goal. But as I mentioned when I opened the conversation up this week with the micros, if your whole idea around trading is based on a fixed percentage return, mine, for this model, this idea of showcasing it, in some people's minds, it may be too high. 7.5% a week it's a respectable amount of money. Okay, no matter what you start with, 7.5% growth a week is really, really, really good. It may be too high for you, but if you aim for, say, 2% a week, it's even easier. If it's 1.5% a week, very, very easy. But I think for someone that's been studying with me and they have a model that works well, I think honestly 7.5% is realistic. And the numbers are the testimony to it. If you take that 7.5% and you do it over the course of implementing a $5,000 base of equity, whether it be that's your buffer for your prop account, or if you actually put real money in an account, the real money obviously is more risk. You could lose that entire thing. The prop, whatever your buffer is before they blow the account out, say it's close to $5,000 or whatever it is. I don't know. I don't trade prop. So I'm just hypothetically saying there may be a prop account out there that's essentially $5,000 before you blow it. Either way, it's the same thing. So if you go in thinking I'm going to trade with one micro, and what's the minimum that you have to do to get 7.5%? What's $375 for one micro week one? The fixed percentage gain stays the same. It's not going to fluctuate. It's going to, whatever it is that you set for as a target, that's you're going to do it. Well, if it's $375, you have several ways to skin that cat. If you're going to try to trade every single day, all you have to do is make 37.5 pips, or I'm sorry, 37.5 handles. If it's 4x, then that's what it would be too. But if you're a high frequency trader and you're using the models that I teach, you're hopefully seeing the reality is that 37.5 handles is not hard. Like you can get a dozen of those in a day, in one single day, one 24-hour period of trading, all sessions. You can do a dozen of them, up, down, both directions without even a bias. But now bringing in the ideas of the opening range, looking at pre-session, obvious draws on liquidity, working with a bias, all these things coalescing into more odds in your favor, not perfect, not without a doubt, you're always going to make money. That's not what I'm selling here. By using these enhancers to just simply trading intraday volatility, where you work with one side of the marketplace. You only want to be a long taker, or you only want to be shorting today. Where the probabilities are on the higher time frame, sticking with that. Using one micro, if you can see a trade that frames out the potential based on what I teach, 100 handles or more, and you watch me do it today with a live account. It's a real account that was not demo, okay? One micro did what many of you earn on a day's wage at your job. And it wasn't that hard. It wasn't that long of a trade in there. Using the levels I've identified, the buy side was a minor buy side, and the sell side was what it was. And I gave you a minor sell side, and I gave you the hardline sell side. I was in Dodgy's live stream, and I said that I favored the idea that they were going to take out the CPI low. I felt they were going to run that. And then when I gave a visual representation of that, you knew exactly what I was looking for. Now, if it would have ran up the minor buy side first, then I would have taken any short from after that initial run. But because it was back and forth inside there, I said, I'm not interested in anything yet. Can't see anything yet. But then it poked its head below that inversion fair value gap, the big orange box. Once it did that, it traded back up inside of it. I knew because it had reached for the relative equal highs but failed to do it. And they're going to gun for those CPI lows. And if it's going to do that, it's going to go for the hardline sell side, which was annotated in the chart that I posted on X. So I just simply did that trade. I knew it was going to give me more than 37.5. I knew it was going to sweep the low. So I went just a small degree below that, placed the order in. You saw everything that's in the recording, and then bang, hammered it. Way above what the model calls for by the math. The technicals bring that mediocre model, that's simple math. If I want to make 7.5% a week, all I need to do is find a trade each day, 5 times a week, for 37.5 handles. Okay, so if I look for anything that looks like 40 handles, which is easy to spot if you can read price action the way I'm teaching, if it's affording it to you, running on an old low or running on an old high or relative equal highs or an inefficiency that's below or above the market, whatever you're looking for as a draw, and that's the beauty of what I teach, you have that flexibility. You can pick that. And I'm just using simple liquidity runs. That's it, using a fair value gap entry model. In this case, it was the inversion fair value gap and targeting the liquidity that was formed on the initial run up at 830, which was a really muted CPI number. And because the data's, nobody trusts that data. It's old. Like all the data they're releasing, I don't have any faith in any of that stuff. And until they get things sorted out, it's probably going to stay like that. But real micro contract, real brokerage firm, not demo, and it's the same stuff I teach. That same simple approach done in another trade, put over $400 in the account. Now, I don't know about you, but when I was working as a working man, a 20-year-old, whatever, before getting into this industry, $400 in one day, that's good money. I mean, that's good money. You do that every single day, it's $2,000 a week. You can make ends meet with that. If you're not living above your means, you can do it. Now, if you have 12 kids and you have a gambling habit and a substance abuse problem, then probably it's going to be a hardship for you. But I'm hopefully talking to someone that's got a little bit of common sense and knows that they shouldn't end up in that situation. But the micro plan that I offered as a suggestion, I'm actually implementing that. I'm actually putting it to task. And as you make money, okay, as you make money, as soon as you get to $2,500, then and only then can you do another addition with a micro contract. What? I gotta wait that long? Yes, with this volatility, you absolutely have to. You want to do this the right way where it gives yourself a chance. And the math works. It's very liberating when you realize that you don't have to have an ultra tight stop. You don't have to have that. When you have a 1 micro, it's $2 per handle. What happens if you're very, very brand new? Okay, you're brand new. You see these relative equal lows. You feel confident it's going to go down there. The daily chart looks like it wants to keep going lower, and you're just scared because you don't want to get into these moves too early and get stopped out. Look at where you think it's going to go over the weekend. Look at old moves, okay? And study where price action was at right before it ran out those highs or lows that you would look at as perfect ideal scenarios to draw on liquidity. How many times did it move against it 100 handles before going there? It's not happening a lot. Not if you know what you're looking for. So what am I giving you as an example? Let's assume for a moment you think the market's going to go lower. And I'm not done. I'll let a couple of you ask some more questions. I know some of you want to say something to me, but let me finish this thought before I get into it. Let's assume you think it's going to go lower. It's relative equal lows. It's real clear. It's obvious. The daily chart's heavy. Everything's working towards going lower. And you see the market create a inversion fair value gap. Okay, so it's an up, close, buy side of sell side efficiency that we've now traded below. So now you expect that to act as a catalyst to get you into a short that goes lower. Okay, your stop would be above candle number 1 that formed that inversion fair value gap. So, I'm sorry, I said that wrong. It would be candlestick number 3's high. So if that is what you're working with, what happens if you go beyond that and you use 100 handle stop? Even though you're only risking the idea of getting to that relative equal low, and it has to at least give you 37.5 or 40 handles, whatever it is, whatever your criteria is. I'm just giving you a suggestion as to watch as a case study in my own hands. You have to come to this conclusion on your own and weigh it out what you think is, because your skill set's going to be what it is. It may be better than what I'm using here. Like I'm just pantomiming someone that's just found their way with a model that's consistent, not perfect, but you're able to find your own way through price action. So I think 37.5 handles, given the volatility, that's reasonable. But if you use 100 handle stop and your minimum expectation is to have 37.5, or we'll just roughly call it 40 handles, and you're looking at a trade that can yield more than that, but you only need less than, you can have a stop loss of $200 risk and then see how many times it goes in your favor. And you may have a negative R as you start this. And you'll see many times, if your analysis is correct, you will be building in a big buffer And if you lose $200 and you lose your mind over that, trading's probably not for you. Because what are you going to do when you're trading and you have $3,000, $4,000, $10,000 on risk? You may not be able to ever trade that leverage. You may never be able to do that. It may be something that says, I just can't do that. I can make money consistently. I can make $500 a day over here and $1,000 a week consistently, but I can't take a stop out or drawdown or in one trade I'm losing over $5,000. I can't wrap my mind around that. And I have students have came forward and said, look, I do great as an income trader, but I can't build it up. I've tried everything I could. And as a mentor, I've done everything I could to educate and encourage and tell them to do this, do that. Something happens in them, they wig out and they can't do it. Is that failure? No. It just means that that's your barrier for right now. Will it always be there? You don't know, and I don't know. But trying to plow through it and force your way through it because you want to make more money, that's the wrong thing to do. So stay in income-based trading and then work towards trying to grow through it through growing pains, but trying to smash through like a wrecking ball. Like I'm gonna get on the other side of this because I should, because I want to make more money. Maybe you're not equipped for it yet. Maybe you need 5 more trading years where you're just making very good living, 6-figure living income. And then something will happen to you where you've matured or you've built up enough money, even as an income trader, that your nest egg is like you can take on a little bit more risk. So even though you may only have $50,000 or $100,000 in your trading account, that $5,000, isn't so impactful even beyond what you lose in your account because you have reserves in CDs, fixed income, real estate, wherever you have it parked outside your trading account. So there's a lot of factors here, and that's what I'm trying to implement and put your focus on something that's the smallest degree of emphasis, which is one single micro contract. I'm not trying to make more than anybody else with that one micro contract. What I'm trying to show is this logic works. This is how you implement it. You go in looking for this. We're not reinventing anything. You guys understand how I trade inversion fair value gaps. You understand how I target liquidity. I gave you the lines that I'm going to use today. And 2 trades, bang, micro, there it is, over $400. Real money, okay? Real money. And my suggestion to you is, what would something like that do for you? Forget all the other stuff you see people doing, whether it's my students or somebody else that's, repping another strategy or whatever. They may be making millions. I got $1 million in payouts. Okay. How's that help you? Where's that putting bread in your pocket? How's that making your bill money easier on your own wallet? If it ain't, then it's useless. You can, all the claps and support and like nod to them like, yeah, it's well done. But at the end of the day, you can't spend their money. So I've had so many people ask me, can you just show us outside of a demo account? Can you just show us what it would be like for those individuals that want to make that transition finally from maybe doing prop, or they've been doing demo enough so now they feel confident. They have a skill set that they can trust in their own hands. They make their own decisions on their own. They're not looking at somebody else to influence them. This is just one way. It's not the only way. It's not the be-all, end-all approach. But I'm trying my best to be a practical voice of reason where it's going to be very difficult for anybody to argue against this as a good starting point for someone that's just trying to now take on real risk. It's responsible on both my part as the educator, and it's responsible on your part as the person trying to implement this information. Because if you're going to try to really risk money, you don't want to do it with a large degree of risk in the beginning, because you can set yourself back in progress by going out there and blowing out real fast. It'll make you afraid of every trade that you take in the future. It will always have that impact on you. It creates scar tissue. So isn't it reasonable for you to try to go in and say, okay, if I take a trade with $2 per risk, per handle per trade, as a trade that takes 30 handles of drawdown, that's $60. You probably spend more at the McDonald's drive-through than that. And How many times you've gone through the drive-through and the meal wasn't even that good? You wish you wouldn't have went there. But you're still going to come back to the drive-through tomorrow and get your breakfast before going to work, right? You're going to go back there and get your kids the stuff. You're going to be doing everything at that same place. You're going to keep frequenting. You're going to say all the time in the world, I'm never coming back here. But you'll be back there before the weekends. So the same mentality needs to be applied with your model. You might take a loss. It may not work for you, but it has to be a loss that you know that this is reasonable. It's not perfect. I'm not going to be perfect. I'm brand new at this. So let me just expect this to happen once in a while and be thankful that when it does, it's not taking a lot from you. And you'll see being imperfect is still profitable. I'll say that again. You can be imperfect. You can miss the perfect entry. You can miss the perfect exits. You can trade with the smallest amount of leverage and be profitable. And too many people get into this and they lose sight of what it is they're learning this for because they watch somebody, they watch me, they watch a student, they watch somebody else doing another way of trading, and they got lots of money. And you want to have that experience. And you want to experience that splash over by being close to them or engaging with them. And it feels good. Like, if I just hang out with them, it'll just happen for me. And it doesn't work like that. You're going to have to earn your money. And I'm hopefully going to be able to communicate that effectively to the individuals that always wrestle with, I got to make a lot of money or I'm not satisfied. Well, if you walked outside your house and someone was nice enough to send you every single day in an unmarked envelope, they were putting $150 in an envelope and leave it in your mailbox every day. Are you going to complain about that? No, you're not. You're going to be thankful. You're going to hope it doesn't stop. You're not trying to ask for more. You're not going to try to leave a note and say, hey, can you leave me more? You don't offend the person that's gifting it to you. And that's what you should be doing with your model. Your skill set and your model in the beginning, be content with enough. Don't say, I've been making money. I've been doing this for 4 days now. Now I'm going to go up and trade a mini. No. You're going to feel like you want to do it because you've been doing something profitable. You've never experienced that before. So you think you've conquered that. No. Stay in it for a couple months. Learn to be an income-based trader. Income-based trading is the surest way of profitability. Building up huge runs in equity, that's a skill set everybody tries when they get into this. As soon as they start making money, they think, well, I'm just going to build the account real big. Until they realize they hit a threshold. Whatever that threshold is, the first loss that comes in there, immediately they forget their model. They forget their confidence they had. They doubt everything. They think every stop hunt that's ever going to happen is now going to happen on the next trade they take. What has it done? It's caused scar tissue. And you're afraid. So much so that even if you did use one micro, you're going to feel the weight of the right or wrong end result of that trade. Why? Because you were rushing to do something you weren't psychologically prepared to do. So you have to build in this plateauing as you make money, as you make winning trades. If you have more than one contract, scale back. Now, what would you do? I'm going to say this part and I'm going to take the next person to talk. What would you do if you're only trading with one micro and that was your income-based idea and you're not building up another contract? So you wouldn't go 5 winning trades and then go back down to one contract because you're already trading at one micro as it is. So what would you do? Don't take the next trade. Paper trade it, tape read it, and see what the outcome is. And then what will happen is you will build this rhythm where you'll get a feel. And what will genuinely happen for you is you will pick up on when you're getting cocky. You will feel like you're King Kong, you're the big swinging dick in the neighborhood. You know everything. You got it all mapped out. You're going to be so rich, and all you have to do is push a button, and it's all going to fall in your pocket. That moment when that happens, you'll be more sensitive to it instead of saying, when you feel, yeah, I am that good. And I'm so good that I'm going to go and trade even larger. In fact, I'm going to trade silver right now because I have big balls. I have big balls because I've made so much money trading in NQ. And I'm going to go out there and conquer silver now. And then when you do, silver takes you and throws you and ragdolls you. And you lose 10, 15% of your account, like that. That's a lot of damage. Emotionally, ego, psychologically, you've harmed yourself. And that carries over for the rest of your career. You're all going to have that moment where you've done something to yourself that if you could have just stopped yourself before doing it, you would have never remembered that ever again. If it would have been a smaller loss on a 1 micro, never would have bothered to worry about it again. But that first big loss where you have size on, or you did something in a market you're not used to trading because now you feel like you got the Midas touch. Everything you touch is profitable. It bites you. And then you're going to regret, you're going to have remorse, and it's going to cause you to second guess everything you do. And the only way you can prevent that is by building in this control mechanism where you have a model that you follow. You're going to trade and take trades until you get a stop out. If you get a stop out, you drop down half the leverage you just took a loss on. If you get stopped out again, drop down and lower your leverage. If you're aggressive about cutting back, if you're trading with 3 micros and it's your third trade that you win on, your fourth trade, you're allowed to take that same trade again. If you take a loss there on your 5th trade, don't trade 2 contracts. Go right back down to 1. The plateau. You need to build in these. Well, think about the exchanges. They have circuit breakers. They only allow the market to drop so much, and then it has to trade up a little bit before it's allowed to, freely trade again and go lower. You have to build in circuit breakers for yourself, and it's just you controlling how much you can do something and when you can do it. But if you go in there and just plow ahead thinking, I'm just going to use, whatever aggressive model of risk management you're going to implement, optimal F, Vince, his name's escaping me now. The guy that Larry Williams used for his optimal F approach to money management. Whatever your form of money management is, all of that stuff when you're winning is great, but there is a loss out there. It's in the offing. It's going to happen, and you want to be able to control yourself and have a track record of you having implemented this in the past, where you, even though when you're on a winning streak, you're sober buying, you say, okay, I have been winning. And while I may not be feeling overconfident right now, I am aware that an eventual loss is coming. So what I'm going to do is I'm going to prepare for that. My leverage affords me 10 mini contracts because of the equity I'm trading right now. So I'm afforded $200 a handle because my equity allows for that. But because I have taken 5 winning trades, I'm going down to 1 mini. Now, for some of you, the way you're going to do it, you're like, ain't going to happen for me. And you're going to blow your account. You're going to blow your combine. You're going to blow whatever it is you're trading. And you're going to waste money trying to rush to get back to that old feeling of what it felt like when you had this much equity or you were that close to a payout. If you would have implemented this idea when you were just $100 away from handing a payout to yourself on these prop firms, if I had $1 for every person in the world that trades these prop firms that sends me an email and says, you ain't going to believe it, ICT. I already know what they're going to say. I was only this much money away, and all I had to do was make this much money, and I could have got 10,000, I could have got 50,000, I could have got whatever it was they were going to get as a payout. And they impulsively traded larger leverage because they felt that's all they had to do is get something big to push them through the finish line. And my response is always, what would have happened if you just would have did 1 micro contract and you used the whole session to get that? You would have accomplished it, and you could have weathered being stopped out a few times and still been very, very close to getting your payout. And it may not have happened that day, but you could have went in the next day, still trading 1 micro, and got yourself to that payout. I never thought about that. Right. Because you're drunk. You're drunk. You're drunk on new equity highs. You're drunk on the euphoria of winning. And you think that the next thing you do is going to be the bigger payout, the bigger win, because you're not satisfied with getting $75 as a win, 37 and a half handles on one micro. You no longer, you've lost your first love. You're doing this to make money. You're doing this in a way where you can do it without any fear of loss. You're doing it with accepting the measure of risk that's afforded to you for the leverage that you're using. But what happens is you don't feel that anymore when you're winning. And that new equity that you see in your account, that's not real money. It's not real money, folks. I don't care if it's a live account or not. It's not real money. It's only real until it ends up in your bank account and you're holding it or spending it. It's all digital money. It's a number. You have not realized that money until you had a withdrawal wired to your account. Then it's real. But you look at that number while it's still ticking around in your trade. I'm up $5,000. Oh, I'm up $6,000. Oh, you're all hopped up on goofballs. So you have to find a way to measure your expectation, rein in your euphoria, manage your fear, manage your uncertainty and your greed by plateauing. Whatever number it is for you, you win, you win, you win. The fourth trade, it might be a loser. So if you have size on, scale back to the smallest one. If you win, you still made money. But if you lose, you didn't lose the most. And that's real important to do in the beginning stages of your career. You have to structure a way of losing in a balanced approach. You don't have to blow the account. You don't have to have breakneck drawdowns to just meteoric drops. You don't have to have that. But some of you think that profitable trading, world-class Robbins Cups responses to building an account where you have to go up real fast and drop down a lot and real jagged up and down. You don't have to do that. You don't have to have your equity curve look like the silver market's chart. Looked great going up, didn't it? And then that's what an account equity looks like when you blow it. And it's completely avoidable. Scaling back, scaling down. So anyway, I hope that answered your question, Daniel. I went a little bit more than would be necessary, but you know that's how I am. Slick Rick, can you hear me? Did you drop off?
Hello?
I can hear you.
Hey, Mike, how you doing?
I'm doing well. How are you?
Good, good, thanks. Everything's hitting home really great tonight. I've been studying your content for about